There's a reason why there's something called the VIX, which is the fear index, right? In the public markets that goes up and down, because that's all it's, tracing. And you don't want to be on the wrong side of that, right? So if you are feeling some angst, like I said before, it's best probably to do nothing.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? And welcome back to another episode on Wealth Strategy Secrets of the Ultra Wealthy. In this special edition, we're diving deep into the current state of the markets, where volatility, uncertainty, and emotion are running high, and more importantly, how high net worth families are managing through it all. My guest today is Shuvam Bhaumik, a returning favorite and trusted voice inside our virtual family office at Pantheon. Together, we unpack the ripple effects of tariffs, trade wars, and geopolitics on your portfolio, why doing nothing in times of chaos might be your smartest move, how ultra-wealthy investors are using investment policy statements to remove emotion and make strategic decisions, the role of private markets, alternatives, infinite banking, and cash in creating true portfolio resilience, and the psychological traps investors fall into. Whether you're feeling rattled by recent market swings or just trying to make smarter decisions for your future, this conversation is packed with wisdom, grounded strategy, and a calming perspective. And stick around to the end for a free opportunity to connect with Shuvam for a personalized wealth strategy clarity call. Shuvam, welcome back to the show.
Thanks, Dave. Thanks for having me. Excited to be back.
Yeah, awesome to have you on. And we really wanted to create this special episode for investors. There's been so much turmoil in the markets of late that we thought we'd be really remiss if we didn't really address this and how we're seeing, high net worth families manage through this type of volatility, right? What kind of insights and recommendations, we've gleaned in our networks that we could share to you guys to help you really protect that precious capital that you have. So appreciate your time, Shuvam. And why don't we actually, I know you probably want to talk about the Masters results as a top golfer. Any big takeaways on that one?
No, it was one of the best Masters I've watched since Tiger winning it back in 2019. But I think the one thing that Rory showed is his grit and his resilience, which was awesome to watch. I mean, there was just so many mix of emotions from the first hole till the 18th hole of regulation. I mean, it was, I kind of was living it through him, but it was awesome to watch. I think as a golfer and golfers that play competitive round, we understand it. And then people just outside looking in, I think appreciated his grittiness and his resiliency. So it was great.
Yeah. No, really great to see him win and agree, man. It was just an emotional kind of roller coaster there in the end. And to the final shootout was pretty cool. So really great to see him win, though.
That's right. No, it was fun.
Yeah. Awesome. So moving on from the Masters turmoil into market turmoil, we've been having so many conversations over the past few weeks about tariffs. What are the implications and everything. Mm-hmm. So, I mean, why don't we kind of really start off with that, right? Is what do you think are some of the implications of, tariffs, global trade wars, and things like that? How can that potentially impact investors? What should investors really be thinking about? We know you don't have a crystal ball. Nobody really does, right? But what are some of the moves that you could be making, or what are some of the data points that we should be keen to keep our eyes on?
Yeah. So first part of your question of what do I think is going to happen? Obviously, I don't know, but I think there is going to be an impact with tariffs on the U.S. economy that's going to trickle down to the blue collar workforce and things like that. Certain sectors are going to get hit worse than others, but also I don't think the administration really has an idea of how this is going to play out. Why the gyrations in the market? Markets always hate uncertainty, hence why you're seeing big volatility moves. In the markets from day to on, you're going to get some normalcy again. Earnings are going to come out. Financial companies are reporting earnings this week, last week. We're seeing some good numbers there. You'll get some normalcy back into the markets again. As far as where I think clients, investors should probably focus, this is an emotional time, right? When you're seeing balances of retirement accounts really fluctuating and things like that. The tendency is try to go one way or the other to the nth degree. And that's probably not the right move. I would say is the best thing to do right now is probably do nothing. Just really let it play out for the next week or two, maybe the next month. And then from there, once you start seeing some normalcy get back into the markets, both private and public markets, is time to allocate. The one thing that I've been telling our clients is really focus on what we're doing in our portfolio. Let us as Pantheon take away the emotions from the investors, really. The public markets, right? You see the valuations going in and out every single day. So people, want to react to that. And typically that's probably the best time or worst time not to do something, right? So what I've been recommending to our clients is let's see what happens over the next few weeks. We have global trade war. We have a war that's going on with Ukraine and Russia that's unfortunately not getting resolved. That's going to have some impact. The Chinese situation is something that we have to monitor because that impacts a lot of us, from technology to semiconductors to just global trade in general. So I think, long-winded answer, David, let's just see what happens over the next few weeks, I think.
Yeah. No, that's sound advice. And, it makes me kind of think back through. So, now I've been through many cycles between 2000, 2008, and seen a lot of this. And I think what's important for people to think about too, right, is you kind of talk about doing nothing, right, which is not reacting, because one of the top reasons investors always go wrong is with the emotion, right? And if you can
Right.
create a strategy for yourself, and I know inside of the VFO, right, we've been working on creating investment policy statements for clients. So you really kind of create that ideal allocation mix, right, to leverage some of the volatility that you might
Right.
have, right, across different sectors,
Right.
and really kind of thinking through, right, yeah, how can you minimize any type of volatility, right? In any different sector? How can you manage your cash flows,
Mhm.
right? And things like that.
Yeah, I mean, I think, as you said, that's why that investment policy statement, as I discussed before, makes so much sense, right? You really, in times like this, you go back to that foundation document and you understand what is the purpose of your portfolio, of your investments. Then you look at your buy box that you created within your investment policy statement and really try to stay very disciplined to that. Times like this, discipline is key. Majority of investors are not disciplined in the sense that they react emotionally, as you just mentioned. Times like this, as you see, like with the bigger investors, the Buffetts of the world and the Ackmans and the Soroses and the Icons, right? They are being very disciplined in times like this. They're not making rash decisions or anything like that. So I think that is very prudent today.
Isn't the majority of the volatility anyway with hedge funds, right, moving the markets in such larger numbers versus retail investors?
Yeah, its majority is institutional. A lot of it is through these algorithmic programs that are in the markets today. So that's why the stock exchanges have put in circuit breakers, right? Once you achieve or you get to a certain level of volatility, I don't know what the exact percentage are, it could be 5, 10, 15%, the market shuts down for a period of time to normalize itself. Once a trigger hits, the volatility goes deeper. As you saw on the big down day that we had, it accelerated after a certain point. Why? Because trigger points was getting hit on these trading platforms or trading algorithms. Same goes for the upside. That's why we had that huge 10% move in the markets on the upside. Same thing on the upside. So yeah, the retail investors are not controlling the ups and downs, but unfortunately, they're the ones that get hurt the most in times like that.
Yeah. Yeah. And also, I think to me, we're constantly refining our investment thesis. And in times like these, it really shows that, our investment thesis, underscores that we're tracking the right way in terms of, getting away from that conventional mix that the majority of people have, which is, 60-40 type of split, in equities, bonds, right? Some type of mix in there, and start to move into alternatives, into real estate, right? Because then you're actually non-correlated. You don't have as much. Maybe you have there was a 5 to 10% move in your equities, but your equities is now only 30% of your overall portfolio. So your whole net worth isn't dropping down 5-10% overnight.
That's right. Yeah. I mean, the key word that you said is correlation, right? And the one thing I would say with an asterisk is the investments that we put forth in clients' portfolios within the family office structure is geared towards, non-correlation, but there's still a level of emotional correlation, as I call it, right? So that's where we come in and take those emotions out of it. But as far as investments are concerned, yeah, I mean, you have to have, uncorrelating assets as it relates to the public equities, because if your portfolio drops 5, 6, 7%, you don't recover that back by if the markets go up, or the portfolios go up by 5, 6, 7%, right? You almost have to, if you drop 5%, you have to, your portfolio has to increase by 8 to 10% to recover that loss, right? So when people are the traditional 401k mix or allocation mix of 60-40, it's been proven that that just doesn't work over time, as opposed to mixing in privates. On a side note, today BlackRock announced that they're doing a partnership with Vanguard to mix in privates with public portfolios for the first time. It's the first partnership ever designed that way, because they understand that privates and alternatives need to be part of one's portfolio, regardless of where your net worth is at.
Yeah, the only problem I see with that, I mean, I think it's great that they're, offering some privates, but what people should be keenly aware of is that if you access a private opportunity through the public markets, you're still kind of coming in as a retail investor. One of
Right.
the things I really love about private is it's almost like you're getting a wholesale deal if you're
Yep.
working directly with a sponsor. And oh, by the way, this is how you get the tax benefits too. Because
That's right.
you're investing in a REIT, or a private, right, as that retail investor, you are not going to get all these pass through, tax benefits as well.
Yeah, you're definitely not. And it's a great point that you made. I think the thesis of what they're trying to do, correlates to what we've been saying for years now. But the mechanism that they're probably going to do it in, I don't know the details, is probably not the most efficient way for investors, right? Tax purposes, as well as just access purposes, right? What we do at Pantheon, having access directly to the manager, right? We get to see the nitty gritty of exactly what's happening on a day-to-day basis from an operational level, uh, cash flow level, project level, all those types of things, which really then we, report back to our investors, which they feel very comfortable with.
Yeah. Do you recommend a certain, portfolio mix, right? How much should people be exposed into equities, or what would you say?
I think in general, a 18 to 22, 23% allocation is the sweet spot. So call it 20% is where one should be allocated to the public markets. Now, obviously, I understand that this depends on a level of net worth as well, right? So as you're trying to grow your net worth, right, you do that through the public markets, and then you have access to the private markets and such. But in general, I like a 20% allocation to public markets.
Got it. And how about the other asset classes?
Yeah, I mean, so Private equity, let's drill down on that. There's real estate. Within real estate, I really like the medical office slash medical real estate space. I also like industrial. Multifamily really depends on where we're looking, and operator, obviously, and obviously, the debt markets. I also like private credit in the alternative space as well. That's definitely not correlated to the what's happening in the public markets. And that sector is only growing. Oil and gas from a tax advantage perspective, as well as, again, not correlated to the public markets. One thing we do at Pantheon is definitely focus on who we're partnering with on that oil and gas space. And, it's been working out well for us there thus far. But again, also the tax mitigation strategies there. So those are the areas that I like today. I am keeping my eyes on certain venture ideas as we're going into deep into 2025, but I haven't, nothing has really stood out to me as far as yet.
Yeah. So if you advocate for a smaller percentage, let's say 1/4 of someone's portfolio in public equities, one of the biggest attributes to public equities is having liquidity,
Yeah.
right? So how are you helping people manage liquidity?
Yeah, so I think that is one of the quote unquote safe havens of the public markets, right? It gives one the sense of security that they have access to their capital and things like that. One strategy that we utilize is infinite banking, using life insurance as a liquidity asset. One, it's obviously an asset from a protection, family protection, and things like that, but it's also creating a little line of credit for yourself, right? So that's the biggest tool that we have been utilizing for our client portfolios for liquidity management. But with all of that said, I think in environments that we're in today, cash is also an asset today. I really believe that because as we go through 2025, there are going to be opportunities that come up that we as the CIO of the family office want to make sure that we're able to capitalize on. We've seen this multiple times over the last few weeks. Forbes continuously published a list of these uber wealthy billionaires that are tracking their net worth. There was only one guy in the top 10 whose net worth went up over the last few weeks, and that was Warren Buffett. Why? Because he's got a hoard of cash right now, right? And he views cash as an asset. It's not something that you always have to put to work. He has it there to take advantage of opportunities and displacements in the market. I view allocations for families almost very similar in that fashion.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve.
Yeah, it's interesting, right? Because I know, talking to a lot of, traditional advisors, they talk about liquidity being, the best attribute, right, of being in public equities. But I don't know, it doesn't really feel too good to actually have to sell. If you did have to sell to get that liquidity when you're in a down market,
That's right.
it just doesn't feel good, right? We can talk about tax loss harvesting, but it's not really great. So I kind of think that people should really think through, and we've gone through like a lot of these, I think real deep thinking exercises inside of the mastermind where it's like really trying to understand, right, the purpose of your portfolio.
Right.
Down to the specifics.
Right.
So for instance, if you are feeling really emotional right now about the impact of the market and the equities on there, then either A, your risk tolerance, is much lower than you have an appetite, right, for public equities. So therefore, this suggests you should rebalance, right? And then, the other thing is like if you feel that maybe you need more liquidity protection, you're right. Like an IBC policy is the greatest thing, right? Because it's even safer than banks. You can access it whenever you need, and then do that deep thinking to say, okay, hey, I need, whatever that number is for you, 6 months, 12 months, 18 months, whatever it is that I could basically support my entire family. I have enough runway, whether I lose my job, I've got a medical issue or something happens, but I can sleep at night. I can move through this volatility, right, in the short term.
That's right. Yeah. I mean, I think one of the key points of liquidity management is because there's the fluctuation of stocks and things like that. People always want to take advantage, right? So they want all of the upside with no risk, right? They want zero downside, right? And that's just not real today, right? It's just not real in any sector, but it's definitely not real in the markets. Going back, the investment policy statement really matters in environments like this, right? No matter what, that's why I call it the foundation of your financial house. Because when you're going through market fluctuations and volatility, you try to go back to that investment policy statement, look at your buy box and say to yourself, okay, I'm invested right. This is going to make sense for me longer term, and let's stay the course, right? Going back in history, right? One was in my lifetime, the best time to ever buy stocks was in 2008 when nobody was buying stocks, right? And we could go, in decades past of other market recessions where that was probably the right time to buy it. I don't know if that's the case today. I don't have that crystal ball. I think time will tell on where the markets are heading from here. But in general, yes, if you're really worried about your public market exposure, you're right. Your risk tolerance is definitely not what you think it was. And then number two, if you're worried about that capital, you probably have way too much invested into the public side.
Yeah. Yeah. And it's so, it's interesting, right? Because in this day and age, right, with social media and everything, it's just so in your face. So
It
even if you're not logging into your account and trying not to see it, right, it's like it's everywhere, right, in your face. And so it's hard not to be emotional. So I think trying to create some really like guidelines, right,
Yep.
for how you invest, what your strategy is, right, how you check things, what you're looking for.
Sure.
The other thing that I think that's you know really interesting is that 98% of the people out there are always coming to this scenario from an accumulation theory approach, right?
Mhm.
So accumulation theory, right, is, traditional advising, right, where they say that you're going to build up this nest egg and then withdraw at 4% a year and start to kind of take that out, right? So, okay, if I've got a 5 to 10% drop in my equities, I mean, that's going to hurt that plan, right? That's going to significantly hurt that plan.
Okay.
But if you're invested for cash flow in non-correlated assets that are continuing to cash flow right now, right, you're going to have much less of an impact on that.
Yeah, I mean, again, it all boils down to how you set out that investment policy statement, right? I mean, I keep harping on that because that's why it's important. But yeah, the traditional model of the target date funds that you see in 401ks and stuff like that, they don't account for big fluctuations. So as you're approaching, we have clients that are getting near the retirement age that all of a sudden now they don't feel too great, right? Because their portfolios have dropped 5, 7, 10%. And what they thought they were going to get from cash flow all of a sudden now has shifted a little bit. Now their decisions are, do I need to work another year? Do I need to allocate more? Should I look at this other stuff? And there's a lot of all this confusion, as opposed to if you have a total portfolio mix of private equity, real estate, and the public markets, coupled with an IBC policy where you have liquidity, right? Those clients who are set that way are sleeping better at night, right? Like, yes, it's in your face with what's happening in the markets. Side note, first rule of thumb is turn all your notifications off, right? On your phones when it comes to your accounts and things like that. Because the reality is nothing matters. How you feel on a Monday has no bearing on what the market's going to do on a Tuesday, right? And that's what we're seeing literally day to day. So turn your notifications off because it doesn't matter. With that said, being proportionally allocated in a good mix of asset classes, you're not going to get affected as much. So come that time of whenever retirement is for you, you're going to be shielded from these big waves of ups and downs. Not to get political on this show, but we have an administration that the only thing that is certain is uncertainty with them, right? And where I don't know what the exact date is of how many days we're in, but there's going to be a lot of uncertainty going forward on what's going to happen with the markets in relation to decisions that the administration is going to do. That's why asset allocation is very, very important, and sticking to your IPS is also very important.
Yeah, great point. And I mean, another thing that I should, kind of point out to people. I mean, it's pretty obvious, it's right in front of us, but I think sometimes we really overlook it. And it's the fact that, we've just spent a number of years getting back statements from our brokerages, right, or our 401ks that are having like good years. We're up 16%, we're up 20%, right? And everyone is thinking that they're getting these really strong double-digit returns. And I think, frankly, it's very deceiving, because if you have to really look back historically over at least a 20-year period to really realize that, yes, there's some really good years in there, but as you point out, right, like in 22, right, when the market corrects 18% off of your entire growth,
Yeah.
and what it takes to replenish that just to get back up to where you were. This is why the average is at best 7.5%, right, over the long term.
Right.
So, I'm always thinking about, right, equities is like, okay, well, no matter what you're invested in, yeah, I mean, look, it's 88% of advisors, according to Spiva, literally cannot beat the indices. So if they're not beating the indices and it falls down to 7.5% over the long haul, then, it begs the question, can I do better with less volatility? Right?
Yeah, and the other thing I would say is the traditional way of investing that most people do, they put you into some complacency as well, right? Which is a place that I don't want to say you shouldn't be, but you have to be understanding of what's happening. That 18% returns or 16% returns is great, right? But then you have a couple of other things that added to that. You have, I mean, obviously the advisor world with their fee structure that they have, number one. And then number two, it's not very tax efficient, right? So I always say this, it's not what you make, it's what you keep, right? And in the traditional investing world, you don't get to keep a lot of that, right? Because you have capital gains taxes and all of that. So the paper gain is really nice to look at, but until you realize that gain, it's not hitting home, right? So that's why I always say, really, how to build net worth is not happening through the stock market unless you take very, very concentrated positions, which we obviously don't recommend to anybody within our portfolio structure. But the ones that have made an incredible net worth has done that. They've taken big positions in companies and tried to really uproot the board and and then grow their net worth from there. But 99.9% of investors don't have, one, that capital, or number two, have that intelligence to do something like that. So that's why allocating to privates, where you can your ownership structure into something, tax efficiency, as well as the back end, I don't want to call it a windfall, but back end gains that you get, that's also very tax efficient.
Yeah, 100%. I think it's also important to realize really the investor psychology here. So again, if listeners are out there and you have felt over the past few weeks really shuddered by the volatility of what's happening in the market, politics aside, right? if you're having some emotions to that, really try to understand the psychology behind that, because it's really quite fascinating, right? As humans, we have 60 to 80,000 thoughts a day running through our head, and 80% of those are actually, our primal brain, right, seeking security and fear, right? But there's no saber-toothed tiger. All it is like, it's that the market, dropped some percentage points. But
Yeah.
what it does is it stimulates your sympathetic nervous system. So then now you're kind of operating from a fear base instead of a powerful state, right? And if you follow the trajectory really of how all of that happens, right, it's that your beliefs become your thoughts become your emotions, and then your emotions become your actions. So if you're taking actions from a state of fear based on all of this volatility, you're not going to do well. You're not going to be making informed decisions. And this is exactly why Ray Dalio talks all the time, which is their secret weapon, their best, attribute and skill inside their company, and him himself as an investor, is meditation.
Yeah.
Right. And they would literally have breakouts and do meditation, right? Because it's all about taking the emotion out of it, getting a clear head, and making, just rational decisions, and really turning off the amygdala in your brain, right? So that you're making, the right decision that's not emotionally charged. So I think that's a big opportunity out there for you guys. If anyone is feeling, somewhat reactionary, like, hey, I got to do something, or right, I'm being kind of triggered by this, right? Just take a step back, take some time off, do some meditation, go work out, right? And then get a clear head. And again, now let's start to talk about the strategy. And this is why, this is exactly why this show is called Wealth Strategy Secrets of the Ultra Wealthy, because the majority of people don't actually have a wealth strategy, which becomes your investment policy statement, so that you can create, barriers for yourself so you don't make mistakes, right? You can optimize yield and reduce risks at the same time.
Yeah, I mean, you made a lot of great points of just taking a step back, right? I mean, just breathing. I mean, that's
Yeah.
I do it myself, you know, in everyday life, and especially, we talked about golf before, like when I'm on the golf course playing competitive rounds, it's just doing something called box breathing. Simplest one is 4-4-4, 4 seconds in, 4 seconds hold, 4 seconds out. It really, really works. And I mean, there's a reason why there's something called the VIX, which is the fear index, right? In the public markets, that goes up and down, because that's all it's, tracing. And you don't want to be on the wrong side of that, right? So if you are feeling some angst, like I said before, it's best probably to do nothing in this environment.
Yeah. Yeah, it's interesting when I travel too, right? You go to the gym, you're in the hotel, and the first thing, they have on all the monitors, they've got Bloomberg or something, and there's literally like 45 different data points scrolling at you, snapping at you, red, this, that. It's almost like you feel like you're in Vegas, right? With all of these things to just really trigger you. And it's actually really the worst thing you could see, especially in the morning, right?
Yeah.
To kind of trigger that fear-based, thoughts, in your brain. So love it. Yeah, box breathing is awesome. Navy SEALs do that. Any type of breath work is huge. We've had a couple people on the show talking about breath work,
Yeah.
key part of that practice.
Yeah.
Any other final thoughts that you want to share, Shuvam, in terms of, again, maybe data points people should be, watching for, things people should be thinking about in terms of, structuring their portfolios right now, or just basically managing through this volatility?
Yeah, I think a couple of things. The bond markets are always good to watch, right? Treasuries, 10 years, 30 years, as well as precious metals. I mean, gold has been telling a story for a long time that has been ignored because the public markets have done so well. So those are indices to watch. As far as markets from a macro level, earnings, you have to watch earnings, right? Earnings are what really drives the market. we're in uncertain times right now, so you hence the volatility. But in general, markets are driven by earnings. Facebook, Google, these companies, Nvidia, these companies are not going to be really affected by what the administration does over the course of a 3-5 year period. Same thing with the private equity markets, right? But you got to look at earnings, and then in relation to the private equity markets, right? You got to look at operators, right? That's what we do at Pantheon. We really bet on jockeys and not horses, right? Because markets happen, so sometimes that's out of the control of the jockey. So we really do our deep dive on operating partners, and then obviously the asset classes and things like that. So I would always just say, last thing I will say, in environments like this, just take a deep breath, take a walk in nature, and don't react emotionally.
Yeah. Sage advice for sure.
Yeah.
What we wanted to do as well is throw out an opportunity if you've been really struggling through your portfolio, again, kind of feeling some of this emotional roller coaster. We wanted to create an opportunity for you to have a free consultation with Shuvam to have a wealth strategy clarity call. We're going to put that Calendly link into the show notes for you. Do you want to shout it out, Shuvam, now? I know most people might be driving or at the gym or something like that, so we'll make sure to put that into the show notes. But if you're not, do you want to shout out your Calendly link?
Yeah, I don't know what the exact link is as far as
Or how about just your email is good
yeah,
enough?
my email is shavam@pantheoninvest.com. You could always email me there, and I'll get back to you, pretty shortly after. But that's probably the best way to get me. And obviously the Calendly link when Dave posts it to the show notes.
Awesome. Really appreciate your time. Thanks again, Shuvam.
Thanks, Dave.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.